Welcome to the June 24th, 2024 Advanced Report from McGowan Group clients and NetWorthRadio.com listeners. We're going to start this week with a warning. Now, the strong get stronger, the weak get weaker was the title of this week's program. And I want to show you some of the examples as we go through. The regional banks right now down about 15%. Commercial real estate defaults could actually pound those stocks in the fourth quarter. So if something's not working right now, well, you put it on your list for later, and you can always exit now and come back later if it's not working in this market. Now, it's all about Nvidia this week. Nvidia had a huge spike up to 140, and then boom, 125 the next morning. What's happening there? It's a trading pattern we call fast and loose. It's a warning. You know, if something's too much in the sun, everybody's looking at it, it gets very hard to trade, especially when you get fast and loose moves like this week. It's up 152% so far this year. The only one ahead of that is Supermicro Computer, I believe, in the AI space. But it's getting a little crowded, getting a little frothy there. So for some people, it may be time to trim back. Here, because of that tech rally, Nvidia is 20% of the tech index for the S&P 500. And of course, the tech stocks, Microsoft and Supermicro and others, actually helping to drive the S&P to a 15% gain. The NASDAQ 100, which is primarily tech stocks, it's up 17%. And you can see at the end of the week, there was some serious profit taking, or at least some temporary profit taking in that space. I would argue that there are some better spaces with less volatility, and we'll cover some of that as we go. Here's the Dow. It's only 4% year to date. In other words, the tech stocks, it's a thin market. They're driving the returns, especially in the last few weeks. Although the Dow at near 5%, that would annualize at about 10% because we're almost halfway through the year. I'm Spencer McGowan, your financial weatherman, president, McGowan Group Wealth Management. We love our clients. We love taking care of people. We serve affluent families right here from the Crescent in Dallas. 10 dedicated financial professionals with advanced skill sets. That's the team that you want on your side. And if you want to get a plan done quickly, well, you can set a time for a Zoom call or come into the office and boom, you'll get a written plan right there. Just because we talk about something here doesn't mean it's a recommendation for your portfolio till you get a written plan from McGowan Group Wealth Management. All right, moving to the interest rates. Yield curve is upside down. There may be an irony in the year ahead. So Goldman Sachs' Hatzius, a very well-respected analyst, came out and said, wait a second, we think there's going to be a rate cut in September and another one in December. And of course, that's a little more aggressive cuts than most people have forecast. And September, well, that's only about 90 days away from that. Now, there's an irony in here. Most people think all bonds move together, but the yield curve's been upside down for a long time. That means the 10-year Treasury and the 30-year right here, they're below the extremely elevated Fed funds rate, which is 5.25. Now, the European Central Bank already lowered theirs to 3.75. So you could see that they probably ought to be at about 4 with the Fed funds rate. And as they do that, it tends to increase the value of high cash flow investments because of the models that investors use. Well, let's say they start cutting that. A more normal yield curve, if I commit my money for a 10-year Treasury with duration risk, I want more than the cash rate. What could it look like 3 years from now? Initially, as they start to bring this rate down, these rates normally would be about 1 or 2% higher than whatever the cash rates are. Now, that steepening of the yield curve could provide a great opportunity in long bonds, but it may provide some losses from duration risk along the way. So, anyway, short rates, the forecast is to go to about 2.5% or just above over the next 3 years. That's important to keep in mind because it's the exact opposite of all the pressure of the tightening cycle in 2022. So that's the yield curve education for the day. One thing that may change everything is the deficit spending. The deficits from February through now, the Congressional Budget Office has raised their estimate for this year of the deficit by $400 billion in additional deficit spending. That's massive. These are the deficits, by the way. They do tend to run a surplus in April when people make their tax payments. But in this case, that could be a huge issue going forward. The spending absolutely out of control. Here, we've got crude oil. 81.27 this week. This little spike corresponded to Ukrainian strikes on Russian oil facilities. And of course, you still have the risks of Middle East escalation. The energy infrastructure companies, our estimate is they're trading at about 7 times cash flow, about 10 times earnings. This is 17% over the same price a year ago. This is actually a 5-year chart for the price of oil. Any disruption in supply could bring a windfall, but in the meantime, if your dividends or cash flow are about 5 or 6%, and that's rising, and they're buying back 8% of the stock, which means 5 years from now you'll control 40% more in assets, that's a good equation. And if you get, let's say, a disruption, a shortage, then you could add to those projected returns, especially at high points in the energy infrastructure. I'm Spencer McGowan, your financial weatherman, president, McGowan Group Wealth Management. We look forward to serving you in the year ahead. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.